Okay. All right, so now we are going to look at the balance sheet. So what we're going to look at first is just showing you where the number for retained earnings flows over to the balance sheet, and then we're going to look at the balance sheet in detail. So you'll see here on the right-hand side of the screen where retained earnings is. We just did that. We got 2360, right? And then you'll see on the left side of the screen where the 2360 folds into the balance sheet, where that number transfers over to the balance sheet. So we're going to actually look at the balance sheet in detail. Now, the balance sheet is more persnickety. This is the one where you have to have things, you not only have to have them in order, like with the income statement, you have revenues first and expenses second. So for this, you have assets first and then liabilities and stockholders' equity second. But the assets, within the assets, those have to be in a specific order. So we're going to talk about that. So balance sheet, name of the company goes at the top, Sierra Corporation. The name of the balance sheet is a balance sheet. Now you're going to notice the date looks different here. The date is October 31st, 2022. It doesn't say for the month end or for the year end. And that's because on the other two statements, the income statement and the retained earnings statement, those numbers go up and down, or those numbers can go, those numbers don't go up and down. Those numbers are a number that will continue generally, except for retained earnings, to go up. So like, for instance, your salaries and wage expenses. What it's showing you is it's showing you on those other statements all of the salaries and wages expenses for the whole month of October, right? Well, when you look at this balance sheet, if you look at the cash account, it's not showing you your whole balance for the month of October, right? Because your balance can be different every single day. So what it is telling you is that the balance sheet is what they call a snapshot in time. The balance sheet shows you what the balance was in these accounts on this date, on the last date of the period only. It's a snapshot of the account balances on the last date of the period, okay? So you can see too, the balance sheet looks a little bit different. So we start out with the assets. The title for assets goes in the middle on the top, and assets. And then you're going to see that the assets are listed here, starting on the left with cash, right? Now, the assets go in what is called order of liquidity, all right? Order of liquidity. So order of liquidity means that the most liquid you can have is cash. And what I always like to tell myself is that, how when you have $20 cash in your pocket, it just disappears really fast, right? So if you were to put water in your pocket, which is liquid, it would just run right out, right? So when you got cash, it just disappears fast. So cash is considered the most liquid. You could spend it really quick, right? You just go to the bank and you say, give me my money, and you go spend it. Now, accounts receivable is the next liquid. It takes about, they would also mention this in chapter 2. The accounts receivable is the next liquid because it usually takes about 30 days for you to get your accounts receivable paid from your customers. That's money that customers owe you for services you provided or for products you've sold them. The next is supplies. Supplies are things that you use up in business, but they are not things that you sell for income. So supplies, like for Los Medanos, for a teacher, supplies might be the pens we use to write on the board, the erasers, maybe the paper we use to print things on. Those are considered supplies, right? Prepaid rent would come next, any prepaid expenses. And prepaid rent means that you paid your rent in advance. So it would be like today is what, January 31st. Let's pretend rent's due February 1. And so on February 1, we pay all of February and all of March month rent. So now we've paid 2 months. So the March rent is considered an asset. It's something of value. Remember, an asset is something of value. And the way you can think about it is, if I close my business doors today, close my business, could I turn that into cash? That would be an asset. So if you, on the last day of February, you decided you weren't going to live there anymore, you would be able to get that rent for March back. So prepaid rent is an asset. Okay, and we'll learn later in the class how you move it from prepaid over to rent expense when you use it up. Equipment is also an asset. If we have a bread company and we buy a huge baking machine and we close our doors today, that's our equipment. We close our doors today, we can sell that baking equipment for cash, right? So again, look at page 1-14 for the example on Sierra Corporation for the income statement. Now, when we get to the next chapter, where we do the classified balance sheet, which will not be on the exam. Remember, you'll be doing this and a balance sheet like this on the exam. But when we get into the classified balance sheet, you'll see that there's a couple other accounts that can come into play in the assets, and we'll talk about where those plug in. Like, for instance, you would have cash first, and then if you had debt investments or short-term investments, they would come next. But you won't have those in chapter 1. All right, so we have total assets. The total assets are $21,910, right? Now we have the second part of the statement. In the second part of the statement, the title is called Liabilities and Stockholders' Equity, okay? So the first section is liabilities, and that is what you are liable to pay. So those are, you owe those money to people, and so you have to pay them back. You're liable to pay them, okay? So again, you do not have to have these in an order. However, I strongly, strongly suggest you follow the order in the book because it will help you if you make a mistake and you need to go back and look in the book at the model, okay? Because I'll tell you what, like in the real world, we never list notes payable first. We always listed accounts payable first, and then we would list notes payable. So this is the order that Wiley's offering. We're going to go with this, okay? So we've got notes payable, and they've got $5,000. We've got accounts payable. They've got $2,500. We've got unearned service revenue. They've got $800. And unearned service revenue would be that people have paid us money to provide a service, but we haven't provided the service yet. So if they cancel the service, we need to give them that money back. So we're liable to give it back until we provide the service. Salaries and wages payable, $1,200, and then interest payable, $50. And then you total up all of the liabilities and you get, you put the title total liabilities, and that's $9,550, okay? The next section is called the stockholders' equity section. So this is the equity in the company, right? And the stockholders, what the stockholders own. So we've got stockholders' equity is the title of the section. So the first one we have is common stock, so $10,000. That's, we have people that own $10,000 worth of our company in stock. And then we have retained earnings, 2360. That's the number that came from the retained earnings statement that we just did. And that creates what we call total stockholders' equity. So that's 2360. Then what we're going to do is we're going to add together the 9550, the total liabilities, plus the 2360, the total stockholders' equity. And that's going to be called total liabilities and stockholders' equity. And it's going to be $21,910. Now there's something very special here that you need to be aware of. In accounting, the assets are going to be equal to the liabilities and stockholders' equity. It's just a formula that always works. So if you look at this, the assets are 21,910, right? 21,910 right here, right? And if we go down here, we're going to see that the liabilities are 21,910. So our assets are equal to our liabilities and stockholders' equity. And that's exactly what we want to happen. We want the assets to be equal to the liabilities and stockholders' equity.